Okay, so there we go. Okay, good morning, everyone. Thank you for joining us at our October Sentio Portfolio Pulse session, where we do updates on our Shariah funds. The session starts at 9:30 sharp, but like we know, a lot of guys just log on at exactly 9:30. So what we're going to do is we're going to give it 2 minutes so that all the latecomers can join, and then Imtiaz will start with the presentation and take it from there. And then halfway through the presentation, he's going to hand over to me, and I'm just going to round up the presentation. Or halfway through the session, rather, I'll just round out the presentation with the remainder of the discussion we had last time regarding a bit of our process and our approach to building what we call an optimal portfolio. So we're going to give it 2 minutes, and then Imtiaz is going to take it away. Thank you.
Hey, good morning. Let's kick off. Thanks, Verlyn. I'm Imtiaz Suliman, for those that don't know me. Welcome to this session of the Pulse session. We're going to be talking a bit about some of the macroeconomic data, what's pertinent at this moment, and also just looking at the contributors to the fund, and then I'll hand over to Verlyn. So let's start. I think this is a very apt quotation by Benjamin Graham, where he says, in the short term, the market is a voting machine, but in the long run, it's a weighing machine. And this is very important because you can get quite significant swings in the market that strays very far from its fair value. But ultimately, over the long term, markets are more able to assess the fair value of an asset and bring things back into balance. But I think it's also an important voting saying where, there's the word voting. And we're going to have the US elections next month, which is going to be also quite an important event in this year's calendar. We'll talk through, some of the implications and what we expect from that event. But nonetheless, that's going to be a near-term event that could sway the markets quite significantly. Just recapping on the performance for the month and for year to date, what you can see is year to date, financials are the clear standout performer. They've returned just under 24%, and for the month, 2.5%. Industrials also had a very good September, up 5.4% and close to 18% up for the year. Bonds have done very well year to date, up 16.7%, and the all-share index has given you just under 16%. And again, cash is the steady return at 6.4%. The one sector that has lagged quite significantly year to date is the resource sector. That's only up 3% for the year. And that's on the back of concerns around the Chinese economy and their demand for commodities. Ultimately, we are a large exporter of commodities, and China is a large consumer of that commodities that we do export. So that's had quite a significant impact on the resource sector. But if you strip it out and if you look within the resource sector, gold has been the clear standout performer. The gold metal itself is up 30% year to date, and the gold shares have done significantly better because they a leveraged play on the gold price. So if you look at it, what's done well over the last month and year. For the month, we had the likes of Implats up 25%. You had Prosus, Naspers up 14%, Kumba up 13%. So there's been quite significant moves for the month of September. But looking at it more on a longer term basis, you've had a strong domestic SA Inc. theme that's come through. So year to date, Mr. Price is up 75%, Truworths is up 50%, Harmony, the gold share, up 50%. So there's been quite significant moves in single stocks that mask some of these figures that you see from a headline level. And it's important that one understands this because we as a stock picker ultimately is looking for those stocks that we think are going to outperform. Some of the underperformance for the month and year to date, Sasol has been a significant underperformer, down 36% year to date. The PGM sector has also performed quite poorly, although they're starting to come back and there's some demand emerging in that space. So we look at these macro factors, and whilst these themes are largely the same, the underlying fundamentals and drivers are being updated as we speak. So if you look at inflation, that's become less of a concern now, and unemployment is a bigger concern for the Fed. We saw the big rate cut out of the Fed last month, whereby they cut rates by 50 basis points. Our Reserve Bank cut the interest rates by 25 basis points. And ultimately, this has started the beginning of the interest rate cutting cycle. So we do think it's still very much going to be data dependent, but the focus has now shifted to unemployment rather than inflation. Inflation has come down from 9% in the US. It's now below 3%. Still not at the Fed's target of 2%, although quite significantly down from its peak. And then subsequently, unemployment has started to rise. We've seen an uptick in the unemployment rate. And if things weaken quite significantly, that will be a worrying sign. So ultimately, we think we're still going to have a soft landing scenario, and that's going to be the most likely outcome, although we're keeping a close eye on things that could get much weaker and economies that are starting to weaken further. From a geopolitical perspective, this is something that's always been on the radar since the Russia-Ukraine war. We've had the uprising in the Middle East, and things have escalated last month, although we've seen some pullback on that front. So, geopolitics is something that's going to be a feature for a while. I think what we're seeing from a world perspective is that different countries are aligning to different blocks within the two major powers. So we've got the West and the East, and within that you've got the BRICS composite, which is also growing in prominence. China, we're going to talk a bit about China, and I think this chart is quite significant because it speaks a lot about what happened in China. And towards the end of September, we had a massive stimulus announcement by the Chinese Reserve Bank, by the government of China, stating that they're going to support the economy. We've seen China's GDP undershoot the official targets of 5%. And this has started to worry the policymakers in China. So once that announcement came out of there's going to be monetary support, fiscal support, we saw a massive rally in the Chinese all-share index. So this is the chart of the Chinese 300 major listed companies, and they were up 27% in the span of 2 weeks. We've seen some pullback since then as the market tries to digest just what the impact of this stimulus is going to be on the economy and whether it's going to sort out some of the structural issues that we see in China. So the structural issues that we have in China is we've got a property sector that is largely vacant, or there's a lot of vacancies in that sector. And we've seen property prices come under pressure in China. And why that is important is because property makes up around 70% of the Chinese consumers' wealth. A lot of their wealth sits in property, as opposed to some of the Western countries where there's a diversified mix between different asset classes that makes up the consumer's wealth basket. So as property prices come under pressure, that puts a dampener on consumer confidence, and that translates into lower consumer spending, and ultimately you in a deflationary spiral. So China wants to avoid what we saw happen in Japan, and the Japanification was essentially a bursting of their property bubble in the late 90s, and that took a very long time to rectify itself. So we've seen the stimulus announcements come out, but we haven't seen a concrete number being put to the stimulus amounts. There's been various amounts thrown about in terms of support for the property sector, support for companies buying back their own shares, and some support for consumers in the form of consumer vouchers being issued. But ultimately, China hasn't come out with a concrete figure that they're going to take this economy and support it until we see a resumption in consumer expenditure. So it's something that we're watching quite closely, and we think there's going to be more announcements coming out of the central bank in China to support the economy. Looking at the stock contributor, and it's one that we've touched on in the past, it's Clicks. Clicks has been a very strong performer year to date, and it's been a good value adder for the fund. So if we look at Clicks, ultimately Clicks is a pharmacy operator with a front shop offering. That combination between the pharmacy and front shop offering is a very powerful model, because what that allows them to do is to supplement some of the lower margin business that they make on the pharmacy side with the higher margin product that they sell in the front shop. And ultimately, they're a beneficiary of the corporatization of the pharmacy space in South Africa. So we've seen the likes of Clicks and a Dis-Chem taking share from independent pharmacies. And this is a trend that we think still has growth. So if you look at the total corporatization rate of pharmacies in South Africa, that stands at close to 50%. Clicks and Dis-Chem being the biggest players, and we think that that could go as high as 75%. So there's still a lot of runway in terms of growth opportunities for the likes of Clicks. They have about 900 stores countrywide, and not all of those stores have pharmacies in them. And that's another lever that Clicks has in their stable in order to support the growth ambitions that they have. So Clicks generates very good returns on its capital. It pays back a lot of that in the form of share buybacks and dividends. It's got a strong management team in place, and ultimately it's a virtuous circle in terms of them being able to grow their footprint. They supply a lot of their pharmacies with their own in-house wholesaler called UPD. UPD is a wholesaler of medical equipment, drugs, etc. And ultimately that allows them to see areas that are growing faster and enter those areas, because they don't just supply the Click stores out of UPD, but also the independent pharmacies as well as the big hospital groups. So we've had Clicks in the portfolio for a number of years in different amounts and varying weights. It has become more rich of late with only 6% upside. And that's why we've taken a little bit off the table recently. But nonetheless, it remains a core anchor stock in the portfolio that we like because of the longer term growth metrics. But when it does get closer to its fair value, we will trim some off. So just delving a bit deeper into the financials of Clicks, you can see that at the interim results, turnover was still growing at a healthy 9%. And this was despite the tough macroeconomic environment that we were in. And although GDP is not shooting the lights out, Clicks is managing to grow its turnover well ahead of inflation. And this speaks to its strong model of offering convenience type product, a very defensive offering in the products that Clicks offers, the likes of beauty, health, and wellness is something that the consumer values and will prioritize over some of the discretionary items. And what that has allowed them to do is also increase their margin from 8.2% to 8.5%. And one of the levers that Clicks has been using to increase that margin is the proliferation of private label products. So if you go into a Click store, you might buy a wellness product, a beauty product, or even a pharmacy product, and it most likely would be their own private label product. This is a higher margin product to the likes of Clicks, and it's been growing in prominence. So if you look at the total private label penetration within Clicks, that's up to 30%. Again, that allows them to generate very good returns on the capital employed. So they grew their top line by 9%, the margin increased by 8.5%, but ultimately earnings grew by 13%. And this is a combination of a higher margin, but also because of the share buybacks that Clicks has done. The dividend was up 13.5%. And again, it speaks to that model of Clicks paying back the dividend to their shareholders and reinvesting in the business. And they can do both quite comfortably. Return on equity is now at 43.4%, and this is really a world-class leading metric. If you look at some of their peers, they're well below this. So Clicks really generates very good returns on its capital employed. Just looking at its business model, as I mentioned, they've got 900 stores countrywide with 700 pharmacies. So there's still 200 stores that don't have pharmacies. They very conveniently located with a pharmacy within 5 kilometers of 51% of the population in South Africa. It also speaks to the growth opportunities that Clicks has in terms of rolling out new stores, as well as rolling out the pharmacies in those stores that don't yet have a pharmacy. They are investing quite a bit into the online capability, and this is a growing sector and segment for all of the retailers. We've seen, the likes of Shein and Temu really shake up the South African market in terms of online penetration. And a lot of the local retailers had to step up to the plate to cater for this new competition, but also because of the appeal that it has to the consumer. A great example in South Africa has been Checkers 6060, which launched in 2020, just before COVID, and that's been a runaway success for the likes of ShopRite. So we've seen the other retailers jump onto this trend, and this omni-channel offering between online and offline is quite important because the consumer doesn't just shop online or they don't just shop in store, but they want to have the choice and the convenience of having both formats to use at their disposal. So we do still like Clicks. Again, it's an anchor stock in the portfolio, but it has become a bit rich at these levels. I'm going to hand over to Verlyn for the style section, and he'll recap some of the style investing. And if there are any questions, please feel free to ask it at the end or put it in the chat whilst we talk.
Okay, thank you, Imti. I'm just busy sharing my screen. Let me just get back to what I'm sharing. There we go. If you can't see this, please tell me. It says recap on style performance. So, guys, last week, if you can't see recap on style performance now, you better speak now, forever hold your peace. Empty. If it doesn't show, please tell me.
No, we're all
But
good.
last week, we talked about a bit about what we spoke to at Meet the Managers on how we manage our different styles and the distinction between value, growth, growth, quality, and the difference between all of them, and the fact that not all of them actually perform equally well across all different types of business cycles. So this is a chart that should, if you were in the last session last month, this should resonate with you. And basically, it just shows, quite simply, don't look at the numbers, just look at the clusters of how value outperforms versus growth and quality during a specific period. So if we look at 2016, for example, this is one example I'm going to make of this. Value had a very strong run in 2016, returning 43.8%, but then you will see growth and quality lag that by quite substantial margins. And then we can go and do the same type of thing here in 2012, where we can see growth and quality did really well, but value had a very poor performance relative to those two styles. Now, when you're in a multi-asset portfolio, and Sentio being style agnostic, we need to figure out when to blend these in order to build what we call an optimal portfolio. So what sectors and markets drive style performance? And style is value, quality, growth. But let's see what happens here. So if we look at the sectors, you will see value is in red, growth is in light blue, and then quality is in dark blue. If we look at sectors that drive performance, you will see the bar chart. Obviously, if you're on the right-hand side, you're in a positive area. So the sectors that drive value styles tend to be mining, energy, and chemicals. So those are two value plays. So obviously, when these shares do well, they outperform, and then obviously in a specific business cycle where mining does well, your growth and quality would tend to lag slightly. However, if we look at consumer defensive, obviously defensive being the word here, as when you're going into a bit of a difficult business cycle with rising interest rates, you will tend to go for a quality company, and that would then be the play you would make. You'd obviously see a growth company in this specific area, maybe because they're highly leveraged, would tend to underperform, and value is quite flat. And in that sector there, and then at the bottom you would see technology. Technology is not really a value play. So a company that's a value company does not tend to operate in a technology sector. However, you will see that tech companies generally tend to be growth companies, so they tend to offer a very big upside. But here is a very short summary. This is not an exhaustive type of slide, but just to show you guys which sectors tend to move along with specific styles. So mining is not a quality play, it's not a growth play, it's a value play. Energy and chemicals, again, it's a value play, it's not growth and quality in style. Consumer defensive tends to be quality, and then obviously your tech shares tend to be your growth plays. Markets, the type of market that supports the different types of styles. So if you look at this here, inflation, when you have rate shocks, we have very depressed prices, value tends to be the play that you want to do. Obviously, when you've got these types of things happening here, value outperforms. Growth and quality would not be the right type of share there. When you have a bit of a global recovery, obviously you would tend to go for a bit more value play. So that's along the market cycle. If you have a bit of a global recovery, value would be a bit of an outperformer relative to the other two. SA collapses. That was a bit of a concern last year when we had a lot of load shedding prior to the election. That was also sort of a bit of a concern. Their value was not really big. So you could see if there's a lot of uncertainty, you know what, growth growth tended to be the thing there. That's the market that was supported in this scenario here. So what I want to emphasize is that we look at specific scenarios in this, and there are specific scenarios that underpin return in specific styles. Now, it's for us to decide where we are in the market that supports one type of style we would pursue versus other styles. And then we've got economic shocks or a market shock. And in that perspective, you actually want quality. Again, growth in quality then outperforms your value share. And this just illustrates that different markets also then have different types of styles that work well in that market. So depending on where we are in the business cycle, depending on specific types of scenarios playing out, scenario analysis, we would tend to pursue specific shares in specific sectors that we showed previous slide. And then according to that, we will then appropriately asset allocate across the different types of styles, what we think is actually the most appropriate for where we are. So how do we combine it to create an optimal portfolio? So guys, this is an optimal risk-adjusted return, 5-year rolling. So this is a very linear type of slide. So please excuse the hard lines, but it just illustrates quite simply that across the rolling 5-year periods, or if you look from December 09 all the way to the end of last year, you will see that actually the allocation between different styles were different. Now, this slide is very harsh because it's got hard lines and it's not always this linear. But the point is if we look at this time frame from 09 to 2019, quality made up a fair part of our multi-asset portfolio or the equity split. Then we would look at the growth that also then made up a lot of the allocation in that specific period from December 15 to December 19. Obviously, there you would see there was a little bit of value added in. And then from there on in December 20, when we went into our COVID period, obviously we went into growth and value. So quality was a play. And then obviously it changed a little bit between the different types of styles. So it's not always the same type of asset allocation. It changes depending on the market cycle that we are in. So we diversify the source of returns by combining the styles. So according to us, at this point, a bit of a house view, the optimal risk-adjusted or the optimal portfolio to give you the best risk-adjusted returns. Generally, we think 38% of that portfolio has to go into quality. Growth has to have about 40%, and then value makes up about 22%. And we're going to show you why value makes up a small part of this portfolio. But this is our optimal mix in terms of styles within our equity block. So that's our house view. So trying to time the market, obviously, you've heard this, don't time it, time in the market. So let's just look at this, a relative return 1-year rolling. So if we look at this is our quality return, the flat line, so it's either positive or negative. Don't look at the absolute numbers, guys, just look at the relative performance of the different styles. So you would see that quality and growth actually have got very flat return profiles relative to what we're going to show you now. So if you look at value compared to quality and growth, the value problem is that it's got very short periods where it gives you rather large returns quite quickly. And you don't want to miss out on that. So you don't want to exclude value completely. You want to have an exposure to value in order to capture this. But obviously, if you want to have an investor remain invested, you don't want to have a pure value type of portfolio because this is actually very distressing to an investor. So yeah, then we've got the optimal mix, which is a light gray line, the gray line there. So the optimal mix, we're going to zoom in a little bit in this period here. Let's have a look at it. So December 14 to December 17. So we're now just zooming into that specific period, guys. So just look at it. So the growth is the blue line. The value, you will see there was the value spike that we could have missed out on. And then we have an optimal mix that actually gives you sort of the best of both. It flattens out the return line. It still gives you an upside above what you would have gotten just by being in growth, but it takes out this volatility that value has. So over the long run, the optimal portfolio takes all of the upside that happens quickly, but it also manages the downside risk. So let's quickly look at this specific block. This is obviously the COVID period, round about there, and look at that massive spike in the growth and value. So if you didn't have any exposure to value, you would have missed out on that. But let's quickly look at it again. So again, we're just going to talk about growth. There's a flat return profile. And then we look at value, and you will see this very sharp value spike here. Obviously, if you're just a value investor, you would have bought into that rising market and potentially would then have eroded your returns properly all the way to where you started, and you would have lost 2 years of returns if you just went into value. So with the optimal portfolio, you tend to capture a bit of the upside without having all of the negative downside, because at the end of the day, guys, the idea of an optimal portfolio is to reduce the volatility in the portfolio whilst giving you the opportunity to participate in the upside. And keeping an investor invested is actually adding, in the long run, you tend to add 1 to 1.5% just by managing an investor's behavior. So the proof is in the performance. So this is the long-term performance of our optimal portfolio or our optimal mix. If we look at value, growth, and quality, and then we look at it just to show you something, and here, time spent at the bottom. So every style across this period was the lowest performer or the worst performer. Now, value, you will see actually, because of those short, sharp spikes, does actually play a role. But in the long run, in our scenario, it hasn't really given us a great annualized return. And it spent literally out of this whole period, almost 50% of the time, was the worst performer. So obviously, you don't want pure value. Growth for us over this period gave us a 14.7 return, which is quite a strong return. Time spent at the bottom, about a fifth of the time, so not too bad. But it did spend some time as the worst performer. And then obviously quality gave us 13.8, and the worst time spent at the bottom was about 20% of this time it's spent at the bottom. So yeah, and then obviously the Aussie, that gave you 13.2. So if you went into these two specific styles, yes, you would have outperformed, but obviously you want to reduce the downside risk. So you want to reduce the downside risk quite simply because you want to have the investor remain invested. And that adds a behavioral return that you can't quantify on a slide like this. So when we did the optimal mix, you will see we came out with an annualized return of around about 13.8. So we outperformed the Aussie, but the optimal portfolio never was the worst performer versus all of the styles. So you will see that all of the styles individually spend some time at the bottom as the worst performer. They also performed really well on the upside, some of them, versus the Aussie. But the idea at the end of the day is you want to do two things. Is you want to improve your risk-adjusted return, which in this case we did with the optimal mix, because we spent no time at the bottom with that optimal portfolio, and we gave you a decent return at the end of the day, slightly underperforming growth, but outperforming the Aussie, matching the quality, but not spending as much time at the bottom, and then outperforming the value play by quite a long shot. So how does Sentio do it? Quite simply, we've got a bit of a process that we follow. So we've got a style-based idea generation. So the guys would look at different types of styles. Discussions would happen around where we want to be, what we want to do in the office. This happens quite regularly. And then we would start with the valuations. Obviously, Sentio is a valuation-driven company. You would actually make sure that whatever you've identified or idea that you've got in mind gets debated. Is it the right play? Is it the right sector? Is it the right style? Is it the right company? Where are we? What are we looking for, going forward? But then the valuations start playing, and we start valuing to see whether what we are buying is actually good value. And that only gets determined by doing a bottom-up valuation of what you want to invest in. Then we introduce what we call machine learning. So it's actually just a bit of a conviction engine. So we draw information from a lot of data sources, and this is where our machine learning then comes in. So we've obviously got our own ideas of what's doing well. The machine learning process basically crunches a whole lot of data and gives us a conviction based on what we feed it. So obviously it's a learning tool, but then it gives you a bit of a conviction. So if we say maybe it's a value play, or this specific sector is doing well, we would always look at what the machine learning tells us to say whether the conviction and what we are feeling is actually true, because you don't want to get caught up in your emotions. You actually want factual information to underpin the whole process. So that's how we use our machine learning. And then obviously based on that, we would make allocations to the specific types of shares, specific sectors, specific markets, and then we would do the portfolio construction and the risk management, and then make sure that you get your best risk-adjusted return possible for the long-term investors, so that we can keep the person invested, reduce the downside risk, and optimize the upside potential. Now, this process has worked really well. Sentio Shariah portfolios, I know the equity and the balanced portfolio, the Shariah portfolios versus our peer group. It's pretty much everyone in the market. We've outperformed all of them over the last 12 months. So this process we've embedded now properly, and we trust that going forward we will be able to continue with the success that we are having in our Shariah portfolios at this point in time. So guys, I've given you a very high level overview of what we do in terms of managing portfolios. The portfolio managers can actually drill into a lot of depth in those charts, but that wasn't the purpose of the session. So investing with style, it's just basically we are taking care of timing the market in terms of what is appropriate, because we've got systems and processes in place to make sure that we know whether we are in a value market, whether we are going into a growth market, whether we are going into a quality market, and we try to make sure that we take care of that so that the investor spends time in the market. Like I said, investor behavior adds or detracts 1 to 1.5% annualized over the term of the investment by making poor investment decisions. So we're giving you more time in the market instead of trying to time the market. That's what we think investing with style is. So guys, stay in touch with us. Go and visit our website, Sentio Capital Management. Join us for our monthly sessions. Every quarter, we've got Coffee Connect. That's in our office, and you should get an invite to that. Join us because we're discussing portfolios. I did an interesting session with very good feedback on actually building a portfolio and using a fun fact sheet and talking about the importance of proper asset allocation. Regardless of whether you're investing for the short term or the long run, was very well received. And then just to wrap up the session, these are all the platforms that we're available on. I've got a sneaking suspicion that our Shariah Balanced is also now available on 91's platform. But guys, as we go along, and we are a boutique asset manager, as we grow the assets under management, obviously the idea would be to have all of our funds, especially our Shariah funds, available across all platforms. If you've got a specific question or you want us to help you get the portfolio onto a specific platform that you're supporting, please get in touch with us, and we will help you with that. So that's it from me. Just stop sharing. Get back into the Teams meeting. So guys, if there are any questions, please drop us an email. You're welcome to drop it in the chat box. I don't know if I've seen anything in the chat box. Let me quickly look before we do. No, guys, there are no questions. Imtiaz and I will be wrapping up this year's sessions in November with a very last pulse. That date is still to be determined because we had to actually move it. So we're first going to make sure Imtiaz is available, and then the invites for those will go out. But thank you. The support is much appreciated. If you have any questions, drop us a line, send an email, give me a ring, and we'll gladly assist you. Thank you for attending. If you've done the whole session, send your CPD certificates as soon as possible. Thank you, Imtiaz, for taking time. And guys, all have a good day. Thank you.
Thank you. Bye-bye.